Morning, Top Gun here, Thursday, March 18th, a little after 2 a.m. Pacific Standard Time. This is the YouTube pre-market commentary. All right, the Fed threads the needle. So yesterday, the Fed came in dovish, and it worked out for them. The stock market reversed from being lower and went higher, and the bond market, the 10-year yield only went up 2 basis points. Now, this was a surprise to me because I thought the Fed was in a tough position with interest rates rising, trying to prop up the stock market, the financial markets, as well as contain inflation, which was threatening the financial market. So they kind of had something where they had to appease the stock market and the bond market, and those use the first likes easy money, the second likes tight money, and so it was a very tough spot for Jerome Powell. He seemed to pull it off. I saw a tweet earlier from yesterday or earlier, I think from yesterday, calling Powell a maestro, a la Greenspan. But however, as we speak, with Europe opening, the 10-year Treasury and U.S. Treasuries in general, are interest yields are surging higher. The 10-year Treasury is well over 1.7, up 9 basis points, which is resulting in the futures getting hit pretty hard. The NASDAQ 100 futures are down 1.3% as I speak. So a lot of times what you see with the Fed is the first reaction, and then those 2 hours following it is reversed the following day. And so what I expected to happen yesterday looks like it's going to be playing out today. Okay, and that's because there's fundamental reasons that rates are going higher, namely inflation is here. If you look at the tweet that I've included in the blog from Kevin Smith, inflation expectations are going up. If you look at the chart that I've included of the Bloomberg Commodities Index, commodities prices are going up. If you look at the receipt that I paid $95 to fill my car with gas on Monday, that's inflation. Gas prices are going up. So this is inflationary, and this is going to cause interest rates to rise, because if people want to get paid back with a real return, that needs to encompass the rate of inflation. So this is a problem. This is a big problem. And in fact, I think it's going to break the bull market. So turning to section 3, and it was really good for the precious metals yesterday. And it's going to be probably good for the precious metals today as well. In general, this kind of easy money policy and that leads to inflation is really good for the precious metals. But let me quote from James McIntosh's article from yesterday's Wall Street Journal, where he says, rising yields would again challenge big tech and similar growth stocks and might drag down the entire market. As Matt King, global market strategist at Citigroup, puts it, quote, "If it is just about better growth, then that is positive for equities. But if it is about risk premium coming back, then ugh." It's about risk premium coming back. So I think today is going to be an important day. I've been playing this like it's a bounce, the first bounce in a bear market. Most investors continue to believe that that's a recovery from a correction and a resumption of the bull market. This is to be determined. That's it for today. I'll see you guys tomorrow morning.